Good Saturday morning to you, and welcome to On the Mark with Mark Papa. I'm Gary Byron. Mark is with Financial Resources Group. You can find them online at www.frplan.com. By the way, he also has his own YouTube channel, so you can get his YouTube channel. There's a link on frplan.com, or if you just happen to be on YouTube, simply type in Mark Papa, M-A-R-K, P-A-P-P-A, 5207. That's Mark Papa 5207, and you'll get his YouTube channel. Now, he's got a phone number as well, 860-657-8380. If you have a question for him, or if you'd like to schedule a consultation. By the way, I will go over both of those points of contacts throughout the show. Financial planning and investment advisory services offered through Financial Resources Group, LLC, a registered investment advisor. This is not an offer to buy or sell securities. Please consult a licensed investment professional before making any decisions. Mark, good morning. Great to see you.
Good morning, Gary. How are you?
Boy, I tell you, not too shabby. How was your week?
Oh, it was good. It's always a pleasure to be here, and it's always quite interesting to be here and talk about what happened in the week before, prior to getting here. But anyway,
I saw a nice picture of you and your son. Did he have was there a ceremony that he was at? I saw it on social media.
Yeah, first confirmation, communion. Excuse me, very first communion. Yeah. And it was interesting. I'd bring him to church, and he'd have to cross his arms, so they knew that he wasn't eligible. But now he gets to actually, receive the communion, which he's excited about. And I give him a lot of credit. The kids really worked hard towards it. They showed up to their CCD on time. Mm-hmm. They did their homework, and it's good to see that he's only 9 years old, but he's actually interested in religion. He takes up an interest in religion and Jesus. We've watched Moses on Netflix and a few other biblical shows. So he's a very well-rounded kid. So I'm very, very fortunate.
Well, look what he's got. It's great that it's so young too. When I was 10, I was an altar boy.
Yeah.
I only was an altar boy for 1 year though.
Yeah.
But that's great. Congratulations on that.
That's
good. Proud papa over here, huh?
Yeah, thank you. He's doing all the right things. That's all that matters.
Well, you're a great influence on him, obviously.
I do my best.
By the way, when was it? Was it earlier in the week? I think we closed out April. Boy, with a lot of volatility, a lot of uncertainty.
Well,
what do you think of that?
We had a lot of that. Well, we have the ending of Trump's 100 days as president, and
if you were to give him a grade, what would you give him? A through F. You can do the pluses and minuses.
I got to be frank. There's a lot of good things that got done that are being swept under the rug. With immigration, and I would also say I think the one thing he did trip up on is tariffs, but I still have to give him a B plus.
Okay,
he's and now let's think about this. Everybody has an answer to tariffs. Nobody has. Everybody has a criticism of tariffs. No one actually has an answer. There's several different political organizations, including one that, if you saw, Amazon is going to price in, just similar to what Timo did, showing you what the tariff is going to cost you. And that was actually, I was found out, I think it was press secretary, but that was actually, Amazon actually hired a Chinese firm to actually come up with that idea, and a publicist, a Chinese publicist. So there's been a lot of intertwining between China and the rest of the globe for many decades now, and some of it's starting to come unwound, and some people, the people who are benefiting are the ones who are benefiting from, I think, unfair trade practices are the ones doing the screaming, and obviously the politicians on the other side, it's low hanging fruit for them. Mm. They need to raise money for the midterm elections, so they're saying it's the most disastrous 100 days in history, and the worst market ever, and the worst presidency ever, and he's been there for 3 months. As he highlighted on television, he's only been there 3 months. So
I think he's done more in 3 months than previous presidents have done in 3 to 4 years. So
yeah, absolutely. And I think what he was doing, he was starting big, and he walked back a lot of the different things he was going to do with the tariffs. He has a great secretary, a great Treasury secretary in his court. And I think this is all going to iron itself out eventually. It has to. But I think it's unfair that certain services that we export, it doesn't come in. I'm going to talk about some export numbers in a minute. That doesn't show up. And we export a lot of services. It's not just physical goods anymore. Back in the day, it was physical goods, and the economy of the 50s and 60s was a different economy than we have today. We're a services economy, and those numbers don't get baked in. But I wanted to highlight one of the other things that happened this week, according on the Wall Street Journal, April 30th, was a sign that the tariffs are actually having an impact. And if you look at new export orders for China, fell in April to its lowest reading since COVID-19. So that's 2022. Overall manufacturing in China was weakest in more than a year, according to a survey published by China's National Bureau of Statistics. Now, in addition, you've seen the Chinese pushing back, being very stubborn in their public discourse. But I'm going to prove to you in a minute why that's not going to last very long. I think the Chinese people are much more resilient than the United States these days, and they're willing to dig in as they're not as spoiled as we are. But at the same time, I think that the numbers are the numbers, and I'm going to talk about that in a minute. Another official number out of China was the Purchasing Managers Index for the manufacturing sector, and that's a closely watched gauge of activity as well. And again, I'm reading right from the article, the Wall Street Journal. These are not my words. China's factories came in at 49 in April, down sharply from 50.5. Recorded in March. Now, that is a reading of 50 or above indicates, a factory activity is expanding. Well, if it falls below 50, that shows a contraction. So that's not a good sign. So to give you an idea, Gary, the United States is a bigger economy than the Chinese. And I think eventually if the Chinese treat their people correctly and don't go so far to the communist.
Yeah, but I don't see that happening.
We don't see that happening. Eventually, just based on sheer numbers and income growth and population growth, the Chinese could potentially overtake the United States in form of gross domestic product. As it stands now, we're still a much larger economy. But more so is the Chinese actually export $438 billion worth of goods to the United States. We, in turn, only export $143 billion to them. So there's a huge, $295 billion gap. There's a lot of ways to arrive at that number, but the bottom line here is you're going to get, if you rely on $438 billion and the tariffs start digging in, that's going to bring their economy to a grinding halt. Yeah. And maybe we have supply shocks, but let's face it, the diversification away from the China supply chain, that's been going for a while now. That's been going since COVID. People realize you can't have your high-end manufacturing. You can't have your pharmaceuticals. Look at the shortages we experienced during COVID. That horse has left the barn a long time ago. So I think we're going to see much more diversification. And then we also saw India. I believe India had a big announcement as well, where Apple's going to be assembling all their phones coming to the United States. They're going to be doing that in India. So a lot of different things happening out there. And the uncertainty is still great and people are still shaky. But again, I think these things will eventually iron themselves out. And I think it's a fight worth fighting.
I think it is too. I want to discuss today, maybe we can get into portfolio construction. This is for maybe the equity portion of your portfolio. So let's start with your investment approach, Mark. Can you explain how you construct your multi-asset, multi-factor global portfolio using exchange-traded funds, ETFs, at Financial Resources Group?
Yeah, absolutely. I'd be delighted to bring that up. And the reason, what we normally do is we create a equity sleeve, which is stocks and bonds, or it's just stocks, excuse me. So that's the equity side. So that's like your large cap growth, your large cap value, your mid cap, small cap, those type of things. That's our equity portion. And then what we do is we have a bond sleeve as well, fixed income sleeve. And then, in other cases, we do guaranteed sleeves. That's a conversation for another show. But for the most part, someone will tell us, okay, on a scale of 1 to 100, where are you? And we get them to tell us, I'm a 75. Well, that means if they're a 75, then 75% of their money is going to go in the equity component, and then 25 will go in the bond component, just to keep it simple, or the fixed income or the safe, whatever. So I want to bring to your attention that we use what are called exchange-traded funds over your traditional mutual funds. Now, mutual funds are what they call a 40 Act fund. That's 1940 technology when you own a mutual fund. And the word mutual, unfortunately, means you're mutual. You're all piled in to that fund, meaning you and your neighbor are in the same fund. If your neighbor sells, you're going to, and you want to hold, your neighbor, and there's a gain, you're going to get that gain passed on to you. In addition, they're active management. So they tend to be fee-based. The fees tend to be a little bit higher in those things, in those products. So we like exchange-traded funds for their transparency. We like it for their efficiency. And we like it for their level of innovation. The innovation is just going through the roof in exchange-traded funds. And what's great about them is there's just a huge democratization from what used to be an institutional product that you can only get if you had a net worth of $5 million or more now, or a bigger institution, now down to your average person. And it's going across the board. Private equity, we're seeing leveraged loans, all sorts of different areas where people can gain access to, where it was only for wealthy individuals. But keep going.
No, I had a question, but I don't want to interrupt you.
No, ask your question.
I mean, that's a comprehensive strategy. And you mentioned using currency hedged ETFs, kind of like the Wisdom Tree International Hedge Quality Dividend Growth Fund. Yes. What's that? The IHDG.
Yes.
So, all right. Why do you incorporate these to protect your clients' dollar-denominated assets?
Okay. Well, that's a great question. So let me boil that down, because I'm going to get to that. Let me boil down why we use ETFs. And a lot of it is we're big fans of factor-based exchange-traded funds. Now, let me just put that in English. You have different factors in your portfolios, and this is what started off as what was called the French Fama model. Eugene Fama and Ken French, they had the three-factor model. And they came up with it versus a market cap weighted model. So let me explain the difference. A market cap weighted model is your standard S&P 500 index. The big problem I have with that, and the big problem is why a lot of these products were created, is going back to 2000. What happened was they realized that their entire index was just stacked with tech stocks because tech was so inflated. It was very hard to diversify because it's market cap weighted. Scroll that up to during the financial crisis. Most of the biggest companies in that index were banks, because what was happening with banks, where they were lending money like crazy, making money hand over fist during the housing crisis. So then you had a huge exposure to the worst possible sector in 2000 when the tech wreck happened. And then you had huge exposure to the worst possible sector in 2008, 7, and 8 before the crash. And just going back to more recent times, you have what's called the Magnificent Seven. But what we need to diversify away from, and we prefer a more equally weighted strategy, is to have a strategy that is less attuned to or less concentrated. 10 stocks control over 30% of the index. So you bring up the question, why do I currency hedge? This is a great question. We've seen recently the dollar get weak. Now, that means if you were to travel to Europe and you bought your tickets a few months ago, you'd be okay. But let's say you wanted to go on a trip to Europe today. What happens if the dollar declines by 5%? How much more expensive did your trip just get? Right? Yeah. Increased by 5%.
Sure.
And when you're spending $10,000, so it adds up. So we like to make sure that when we do have any international exposure, that we're hedged against any type of currency risk. And they will hedge against a basket of currencies to help protect our clients who are putting money in those products with U.S. dollars.
Very cool. Now, you've emphasized diversification, including moving away from market cap weighted indices like the Vanguard S&P 500 ETF toward earnings weighted or even equal weighted products. Right? I've heard you say this. Maybe you can explain why, and maybe also highlight the difference between Standard & Poor 500, the S&P 500 equal weight versus market cap weighted ETFs, including, though, their inherited risks.
Well, the main reason is, again, what happens is if 10 stocks, you have 500 stocks, and 10 make up 30% of the index, that means 70% of the rest of the index is the 490. So if you think about it, you're not getting the kind of diversification you really thought you were getting. So when you go at, like, for example, we utilize an earnings-weighted version. The earnings-weighted will reward the companies that are earning or growing their earnings at a more consistent level, and not have such a big slice of, for example, in my portfolio, if you look at the S&P 500, Apple might be 6.5% to 7% of the total portfolio, where we might be down to like 2.5%, 2.2%, much lower exposure to the bigger companies, because you want to have more exposure to the companies that are going to become the next Apple down the road, or the next NVIDIA, or the next superstar darling that eventually climbs to the top of the index.
Sure.
So we want to have exposure to those smaller companies. And in many cases, a lot of those smaller large cap companies are growing at a much greater pace and a much better and more consistently than those big companies at the top who've been dominating the index. So that's why it's important. Now, on an equal weighted strategy, one example of an equal weighted strategy is the Dow Jones. People don't realize this. It's nothing new. The Dow Jones is equally weighted. All 30 stocks get the same percentage of the index. So there's products out there that are that we utilize also that have a more equal weighted strategy where, no one stock is going to be overly dominant, or no one sector is going to be overly dominant in that portfolio or in that exchange traded fund. And in addition to that, we also add in factors that we consider important, like quality, which is a big one. And quality is, strong management, good balance sheets, low debt, high cash flow, high dividend coverage ratios, those type of things. We want to make sure that we own that as well, because quality is typically done very well. So we'll have, for example, you'll see in our portfolio, which is called ROE, return on equity. It's Astoria Financial out of New York City. John Davies, the manager, and they designed what's called the Quality Kings. And the Quality Kings is more of our little bit more defensive, more value oriented. And value is, in layman's terms, you buy a stock, it's a Warren Buffett type stock. Okay. Value is, if I were to, the sum of the parts of the company when I do the valuation is greater than the whole. So I'm buying that. I hope to buy that stock at a discount, knowing that its future value is worth a lot more when I add back in its future cash flows and earning streams and everything else, assets of that nature. Where you have growth companies, where growth companies are the opposite of value, and then growth companies are your NVIDIAs, your Microsofts. There's a lot of smaller players out there, but just to give you some examples, these are companies that are growing their revenues. Palantir. These are companies that are growing, 30, 40% a quarter. Those are growth companies. They have, they're not paying big dividends. They are reinvesting their cash to grow. So those are growth companies. And then in the middle, you have this other factor called momentum. And what's really interesting is people love to tie momentum into high risk and high tech. And it's the furthest thing from the truth. Momentum can be anything depending on the type of economy you have. And I'll give you an example. I use this with a friend of mine who also manages ETFs as well. Just designed a new one. And we were talking on a phone. It's a quick conference call. And I mentioned to him in 2008, a lot of the momentum was going to trailer homes, trailer people who manufactured trailer home stocks. Because people were losing their house and they needed a place to live, and people were just walking away from their houses and buying like trailer homes or, whatever those buses are called, campers and those type of things. And those stocks were just crushing it. And this is when everyone's portfolio was literally in shambles. But there's always a bull market somewhere, as we like to say. I think it's Jim Cramer says that. So that's what momentum does. So that there's products out there that'll help track that momentum. Within, instead of a 12-month look back period, they go 6 months. And they really tighten up that factor to really seek to capture maybe not the absolute bottoms, but they start seeing a 5 or 10% move in a sector, they jump in. So it's pretty interesting. There are a lot of cool products out there.
Folks, you're listening to On the Mark alongside Mark Papa. I'm Gary Byron. Mark is from Financial Resources Group. It's his business over in Glastonbury. You can check them out online at www.f as in Frank, R frplan, frplan.com. Also, 860-657-8380. I'll repeat both those, and I'll even give you a YouTube channel that Mark has more towards the closing of the show. Mark, I mean, listen, everything that you're telling me is a very compelling case for diversification. So why then do you believe that a globally diversified portfolio with large, medium, and small companies across various sectors is more suitable for retirees than let's say, compared to maybe, simply investing in the S&P 500 or even, like the MSCI or the ACWI indices?
Okay, well, the MSCI is like the more of the global. So you have the S&P 500, which is the U.S. benchmark, and then you have the MSCI AQUI, which is we use as our international benchmark, and when we're doing our international portion of our model portfolio. To make it simple, Gary, we want to make sure that if you just have VOO, you have 30% concentration in 10 stocks. You also have the drawdown risk of the S&P itself. And we've seen 20% recently, 30%, as much as 45% drawdowns on your retirement. If you're going to look good. Don't get me wrong. There's plenty of times where people own that S&P 500 and they're sticking their chest out. They're beating money managers. They're beating the market. They're crushing it. Let's talk about on the downside. If you're a retiree and you have a 30%, even a 20% drawdown, you have a significant, in order to get your money back, I think it's somewhere in the neighborhood of 33% rebound in your portfolio just to get that money back. Break even. Now, what happens when I'm taking money out of that portfolio because I need it to live on? And you can pretend that doesn't hurt, but you locked in losses for the remaining. You can do serious damage to the future of your retirement because you're locking in money. You're taking money out that you can't recover because you're locking in a loss. So that's what they call sequence of return risk. So having that globally diversified portfolio of large, medium, small companies, in addition, currency hedging, also owning things like real estate or global real estate, also having a little bit of gold and silver in the portfolio. All these things act as buffers against extreme risk, volatility, and they're not guarantees by any measure, but they do help when things do get volatile. It's nice to see that you had a 4% allocation to gold and silver, and it had a great year. And it feels good to see that, okay, well, the S&P was down, but, our European portfolio actually was up because it rebounded because money left the United States and started going overseas. So you want to have areas of your portfolio when one does well, the other one's not doing so well, and the other one's not doing so well, the other one's doing well. You have to have that mix because it, A, lowers the overall valuation of your portfolio. It diversifies the risk among many different economies across the globe. And it also just buffers the volatility for your client. The big problem people have, and it's even started to happen with this recent sell-off, we were so spoiled with up markets, tons of government spending, tons of sugar high, rate cut anticipations, all this. It was an easy market to make a lot of money in. And then the minute we get one little, what do you want to call it, I'll call it even a mini earthquake, everybody's selling. And then you start talking to people, and you walk in a restaurant, and people are talking about how much they lost. They're bragging about their losses. This is what I used to have. Well, what good is that if we're true advisors? Our job is to protect our clients' money. Our job is to make sure that they're not getting scared out of the market, that they have the wherewithal to stay in the market, because you can't miss the best days of the market. And as any advisor will tell you, if you miss the best, the 7 best days of the market, you're in a lot of trouble. And usually those best days are bouncing off a bottom of a bear market. So you can't afford to miss those. You can't afford to miss those recovery. If you think you could time the market, good luck. So we don't have to worry about timing the market. I could tell you that the phones ring a little bit, but the big clients, the people who understand what we really do and the value creation we're providing, we're not just slapping together portfolios of market cap weighted, because you have a problem with market cap weighted with the small cap index, which is the Russell 2000. Most of it doesn't earn money.
Now, do you explain all this to clients that walk in? What if you're talking over their head? Somebody could sit...
This is an interview. I get people that kind of tell me what they're looking for, but then get them to tell me, I'll get them to explain. I'll explain to them why the small... So, for example, in the small cap space, you have growth and value. Who knows which one's going to win? Usually small cap value wins over long periods of time. So we buy an earnings weighted version because it smooths out that ride. And most of the Russell 2000 companies don't earn money. So why do I want, 3 horses carrying the whole,
Of course not, right. But how often do you get somebody that comes in who just doesn't understand any of this? And they just say, Mark, I'm going to have to trust you with this. They're asking something big from you because, that's like they've known you all their life.
Well, the first thing we'll do is we do our 21-point checklist. Through the checklist where you can get that $100 gift card, I will show you exactly what's going on in your portfolio. 9 out of 10, I'd say I can't give a stat, but a good percentage of the time people are paying way too much in fees. They're getting killed in turnover costs. They're not diversified. When I show them the Morningstar, it's this blue ocean, and the more blue you have, the worse it is. I get them to tell me what was wrong with their portfolio, but that we don't jump from the frying pan to the fire. We then show them a portfolio, and we go down position by position and explain to them why it's there, what's the purpose of it, and we do it in a fully transparent manner. Full transparency. So we're digging in. We're telling them, hey, the fee on this one's going to cost us a little bit more, but here's why, because it has a currency hedge. This one might be a little more expensive because that's an international fund or it's an emerging markets fund, and we have to own a little bit of emerging markets. So the fee's a little higher on that. But overall, we try and keep our fees, in a certain range, like right around 0.34%, which isn't bad.
Mark,
you have to...
I just think I'm running out of time. I just want to thank you. I mean, you listen for everything that you shared in your thoughtful approach, your focus on diversification and risk management. It clearly prioritizes your clients' needs. You put them first.
You have to do what's best, and there's you always have to try and you always have to try to get better at what you do, but take advantage of the innovation in the industry. Don't just slap together a portfolio of market cap weighted or a bunch of mutual funds that are all doing the same thing. Yeah. And that's what we encounter all the time, and those are the things I love to fix.
Folks, if you'd like more information, simply head on over to Mark's website with Financial Resources Group. It's www.frplan.com. It's got his own YouTube channel, so if you're on YouTube, just type in Mark Papa. That's MarkPappa 5207. There's also a link from his website. And if you'd like to sit down and talk to Mark, do that 21-point checklist, get your $100 gift card, call him at 860-857-8380. Again, it's 860-657-8380. For Mark Papa, I'm Gary Byron. Thank you so much for listening to On the Mark with Mark Papa. Until next Saturday morning, have a good one, everybody. So long.